Welcome to New Frontiers year-end market update titled The Turning Tide. I'm Catherine Obiela and I'll be your moderator today. Before we get started, I just wanted to touch on a few housekeeping items. We encourage you to participate throughout the webinar by submitting questions. You can post your questions using the Q&A function at the bottom of the screen, and we'll be monitoring those throughout the program. Today's webinar is being recorded, and once it's uploaded, we'll notify you via email. And if you'd like to qualify for an hour of CE credits, please stay through until the end of the webinar. To keep things interesting, we'll be posting polling questions during the program, and we will share results in real time so you can see what others are thinking. We would also appreciate you taking a very brief survey at the end. With those things covered, let's get started. Today, I'm joined by New Frontiers founder and president, Dr. Richard Michaud, our chief investment officer, Robert Michaud, and senior research analyst, Joy Chen. In today's webinar, Robert will share specifics on how our investment process is designed to handle future changes in the market. Next, Joy will share how recent market performance has impacted portfolios and how new information is being reflected in the positioning of our portfolios. Our founder and president, Dr. Richard Michaud, will then provide a brief overview of our U.S. core portfolios. Robert will then review our recent model rebalances and explore what's driving markets now. Then we'll turn to this quarter's spotlight on Bitcoin, and as always, we'll close out today's webinar by answering your questions in a live Q&A session. Thank you for joining us, and I will now turn it over to Robert to open it up.
All right, thank you, Catherine. So we can hop right into it. We have a lot to talk about today. The first thing I want to talk about is how to invest and how we adapt our investment process for a changing future. So first of all, there's uncertainty about the future. That's the way markets work. How do you build a diversified portfolio given this uncertainty? This was the founding principle, the founding idea, and the name of our company as a new way of thinking about optimizing, diversifying, and building portfolios with the right objective for different investment objectives for in an uncertain future. And so we have to examine many thousands of statistical different market scenarios going forward to be able to build a portfolio for that. So now I'm going to enumerate some of the ideas here. So the first concept, which I think is pretty relevant for two reasons right now. One, because there is a lot of concentration in the market portfolio, and there's some question about its efficiency and appropriateness. And also, two, because this is a Markowitz is on all of our minds, and this is a central idea to his theories. So I think people need to think about investing beyond the market portfolio. That's very important. And just conceptually, if you think about how every individual investor invests, they have their own portfolio. Hopefully, it's a very appropriate portfolio, but it's an appropriate portfolio for their specific goals. Now, when you average all of these different investors' portfolios together, what you end up with is the market portfolio. Now, what that means is that the market portfolio is potentially, at best, an average of many different investors' appropriate portfolios, but it is not actually the right portfolio for any individual investor's goal. So it's an important thing to keep in mind that the market portfolio, the one that you is generally tracked as a benchmark, is not actually the right portfolio for any individual investor. So investing needs a better solution for each individual. Now, how do we adapt these tailored portfolios, optimized portfolios for individual goals? I think is important to keep in mind what's going on in the world. So we certainly should be very aware that fixed income markets have been changing. They're volatile. It's interesting to note maybe that while the long-term rates are pretty much where they were a year ago, short-term rates have changed dramatically. And so now we have a much more inverted yield curve than we had certainly a year ago, and even than we had a quarter ago. The fixed income environment is very different. And so what type of solution might make sense for a changing environment? So I can give you an example of that. An example of that is thinking about just in a balanced portfolio, let's look at fixed income that was appropriate a year ago and fixed income that's more appropriate right now with a much more inverted yield curve. Now, there's quite a few fixed income asset classes here But one that I think really stands out is on the left, we have our new appropriate portfolio. On the right, we have our older appropriate portfolio. Many of you are aware that with a very flat yield curve, a very inverted yield curve, one thing that you might want to do is take advantage of the highest point is right at the beginning. That's also the lowest risk point. So think about what that might mean for your portfolio when the highest yielding asset is also the lowest risk asset. And that should mean that you want to be using that, taking advantage of that opportunity. And so I think many people know this emotionally, and this has to do with why many investors are in cash right now. But I think it's much more efficient and much better for your clients going forward if they have an asset manager that is able to explicitly include this as part of the portfolio. And that's exactly what we've done. So currently, you might have roughly 25% cash, or in the form of floating rate notes, a Treasury floating rate note ETF. And what we think this is the most efficient way to get a virtually riskless, essentially zero duration Treasury note that has the highest yield of any Treasury of any kind, and in fact, higher than many of even the bonds with credit risk as well. And so, of course, the whole thing changes, and I would love to talk about our portfolio in great detail, but in interest of time, I'll focus on that one specific detail. Other things you might notice is that the duration of the overall portfolio might go down, because why take risk if you don't have to and you're not getting rewarded for it, and other allocations will change as well. Now let's switch a little bit. Let's think about, for taxable investors, what might be changing for taxable investors. And so one thing that has happened is, as the bonds have had a very good quarter, for instance, last time, but the riskless bonds don't change in price. And so we have seen that the gap between the yield on a municipal short-term high-rated bond and a short-term Treasury note, like I was just talking about, has widened dramatically. And so now if you look at the left part of this curve, you can see that for short durations, what we are comparing here is the tax equivalent yield. So after taxes are taken into account and we use the highest marginal tax rate that we think is remotely sensible, 40.8%, then even if you take these very high amounts of taxes out, how would the after-tax yield look like when you're comparing something like a Treasury note versus a short-term AAA rated municipal bond? And what you see is there's actually a pretty significant gap in favor of Treasuries. So this is a little bit unintuitive to some people. Like, why would you have Treasuries when you can have municipal bonds in a taxable portfolio? But the answer is, we're not trying to completely avoid taxes. We're not trying to even completely minimize taxes. What we are trying to do is give your clients the best after-tax risk-adjusted return. And so right now, that means that on the short end of the curve, they actually should be investing in taxable bonds. For the middle of the curve, it looks like it doesn't matter too much. And for actually the longer durations, you can see that there is a significant premium to municipal bonds after taxes. And so that's exactly what the portfolio will look like if you look into it. So on the next topic, I want to think about how markets are changing. So markets change very broadly. Equity markets are changing very broadly. And I just wanted to bring back some historical confidence, some historical perspective on this. And we can see over time, the US has always been a very large equity market, almost as far back as markets go. But it has gone up and down over time. And so what many of us remember is that in the 80s, Japan was taking over, and Japan was actually briefly the largest equity market in the world. This is only updated to last year. Now, the US market wouldn't be 58%, it's now 61%, which is fully 10 times as large as the second biggest equity market, which is Japan. And so certainly I'm not trying to say that there's any likelihood whatsoever of the US losing its place as the largest, most important market at any point in the future. But thinking of it as 10 times larger as the second largest market, and thinking and acknowledging that these relationships do change means that you have to be paying attention to how you're allocating in a global or any type of portfolio. So one reason why the US market has been so dominant is technology and innovation. And so there's a good reason why the US is where it seems like always the greatest innovations keep happening. However, you do always have to make sure that you are not taking more risk than you are you understand and you are willing to be taking and is appropriate. And so just looking at this, and this is actually from the middle of 2023, the market is even more concentrated now. You can clearly see that the top 7 stocks are all very much among pretty much one major theme in terms of what's been driving their returns. And that might make you think there's some sort of concentration risk there. It's something that we've been trying to explain, trying to understand, trying to help you explain to your clients how this concentration risk might matter. And I think the most obvious thing is you can say, well, NVIDIA sure feels a lot like Cisco did 20 something years ago. And just think about the US market in general. And I would argue that this is, again, a market very focused on one idea. The idea in 2000 is that the internet would become a very powerful driver of productivity and growth. And that certainly has been true. But it hasn't rewarded all of the companies in the way that we thought that they would in 2000. And looking forward 5 years from 2000, we can see that most, if not just about all of these top companies from 2005, except for maybe Microsoft, have had a pretty serious disappointment following that. And so I think one thing as investment professionals that we want to make sure we're doing is not disappointing our clients. And so setting expectations reasonably, making sure that they're aware of risks, while we still do want exposure to growth stocks, is an important part of our jobs. Now, diversification is always a thing that you want to do intelligently, and you want to think about what's different and what's affecting it, what's your portfolios right now. And certainly a big theme, other than the concentration risk, is that we do have really high nominal rates and a high risk-free rate. And that a risk-free rate is generally thought to sort of raise all boats in terms of return expectations for not just treasuries, but also risky assets as well. And so for interest rates, there has been a lot of risk in the past, but I think interest rate risk is somewhat lower now. I'll talk about that more. The US market has been a very low risk and very high return market in the past. And while it is certainly still a very valuable market, we shouldn't be anchored in the past ever when we're thinking about markets. Europe has had a ton of risk and some poor fortunes, but the market does price some of that in. And so you would expect it to continue to be high risk, but maybe have a risk premium associated with it. And China is an interesting story in that it has been at various points always high risk, but sometimes a little less than others, but it has been low return for a while in terms of not rewarding its investors, and other emerging markets may have higher return opportunities. There's some interesting news lately on China in that they have very recently acknowledged this, and hopefully will be able to make a more accommodative market. So I would like to pause here. I would like to give Joy a chance to explain performance, but before we do, we should have our first poll. So we'd like you to check as many as you think apply in terms of what risks do you think markets may be overlooking. So I mentioned some, but not all. So tech valuation is one risk. The risk in international markets. It's an election year, not just in the US, but globally, political risk, interest rates and bonds valuations, inflation, and also national debt. So I'll give you a few more seconds to fill in as many as you would like. And we will see what you think. So certainly, oh my. So this is a popular question. It looks like people often took advantage of saying there's a number of things that you are concerned with. And I am I'm glad to see that it seems like we are not being too emotional here. And there is concentration risk. There's certainly political risk. And I think the debt may have something to do with why fixed income and interest rate risk might be here for a little longer than we want it to be. So, all right, with that, Joy, you can comment and thank you.
Great, thank you, Robert. Yeah, I can definitely relate to this about tech valuation, market concentration, as I will touch on this section. So as usual, in this performance section, I will start with the market backdrop and then move to asset classes we're investing. And in the end, I will talk about our portfolio performance. So let's get started. First of all, you have seen this from Robert's section, inverted yield curves. I think it's really important just to realize that as we ended Q4, the yield curve has become more inverted compared to a year ago, with short-term rates rising dramatically in response to 4 rate hikes up until July, and also more inverted compared to a quarter ago, with long-term rates declining massively as markets shifted from higher for longer rates to growing expectations that Fed is going to cut rates sooner and deeper in 2024 than previously anticipated, along with falling inflation expectations. And that change in the expectation brought a almost everything rally. And here I'm showing you accurate 2023 performance. As we can see from the chart, global markets went up 11% in the final quarter, reversing from the third quarter's losses and ended the year with 22% return. That's great. And US market did even better, but with a much higher concentration, as Robert mentioned, Magnificent Seven. So here I want to put that into context from performance perspective. On the right, we can see that those 7 companies went up more than 100% this year versus 26% return from S&P. But really, people just start using this phrase to call those 7 companies earlier this year. But before that, on the right, on the left, those 7 companies, the same companies, lost 45% just a year ago compared to 18% loss from S&P. So their 2023 magnificent story is partly a recovery story from previous losses. And if we put them together to look at 2-year accumulated return, we can see that the return difference between the two is not that significant. And it's important to point out that those 7 companies have much higher risk and volatility than S&P and other more diversified portfolios. So with inverted yield curves, Q4 reversal, and growth concentration, let's look at our asset class performance. First, we have fixed income performance for Q4 and 1-year period. During the final quarter, falling long-term rates, as we saw earlier, really led to a rally across the board, especially for duration and rate-sensitive bonds. So as we can see here, long-term treasuries, investment-grade corporate bonds, long corporates, and long munis did really well, reversing previous losses and ended the year positively. Also, because of the rate cut changes, the expectation, dollar went down more than 4% over the quarter, which benefited international treasuries and emerging bonds. They were up almost 10% in Q4. And among all the bond positions, Treasury floating rate bonds were only up more than 1% this quarter because of their essentially no credit, no duration risk. But still, on a 1-year period, they contribute about more than 5% return to the portfolios. And with recession risk not materializing, high yield bonds were among the best performing bonds this year, up close to 13%, followed by short high yield and less risky investment corporate bonds. Another spotlight falls on convertible bonds. They're a very niche asset class for our multi-asset income portfolios. So this year, they really benefited from their 40% exposure to underlying technology sector. They were up more than 15% and helping income portfolios. Moving to equity performance, again, we can see a Q4 rally across every equity position. They went up close to 10%, especially US small caps and US REITs. They really reversed from previous worries and were among the best performing equities this quarter. Relatively lower risk equities such as US Mingle and EFA Mingle here went up less in Q4. And on a 1 year period, we can clearly see again growth concentration. Large growth went up more than 42% this year, 30% more than large value, and 25% more than small caps. And those gaps are historically high, and it's basically dominating everything here. And on the other hand, US high dividends had a not so great year, just went up more than 1%, mostly due to the struggling first 3 quarters. Those traditionally high dividend sectors, such as energy, utilities, and consumer staples, had a rough year this year. And outside US, European equities did well, 12% return this quarter and 20% return this year, followed by Asian Pacific. Relatively, emerging markets had a weaker performance this year, largely due to China. So with asset class performance, let's take a look at our portfolio performance. We have 3 global strategies: global core, tech sensitive, and multi-asset income portfolios. The numbers here represent net of fees performance for Q4, 1 year to 10 year. You can get a copy of performance from our website, and I think the link to that will be shared in the chat box shortly. So overall, it was a great quarter for our portfolios, not only from an absolute return perspective, but also from a relative basis compared to the benchmarks. Global core outperformed the benchmarks by up to 2% this quarter. But on a 1 year period, the story is slightly different. The benefits added through global diversifications were somewhat overshadowed by the lack of concentration in growth tech companies. And similarly, for tech sensitive, they performed very much in line with global core pre-tax. And some of the smaller differences you see here are largely due to muni versus taxable bonds and some of the equity allocation differences. And overall, munis did better than taxable bonds in Q4, which helped achieve a better performance for tax sensitive in Q4, but underperformed slightly relative to taxable bonds on a 1 year period. In the end, multi-asset income portfolios with income and capital appreciation, their objective had a great quarter, which pretty much explains the full year's return. The yields provided by the income portfolios are close to 5%. And I do want to mention that this year, all our portfolios had 0 capital gain distributions from ETFs. And in the end of my section, I want to talk about US core portfolios. They're relatively newer than global core, and now we have a full 3-year track record. And again, very similar story. They had a great Q4 and 1 year performance, and especially Q4 helped by small caps and REITs. They outperformed the benchmarks. So overall, I think investors did get compensated for taking risk last year, and that's the only way to get rewarded. And with US core, given that they're still relatively new, so in the next section, we're happy to have Dr. Richard Michaud to share some of the motivations behind US core.
Yes. Hello. Thank you, Joy. That was great, and thank you, Robert, as well. So let me begin this brief section on focusing on our US-only core multi-asset strategies. These are relatively new to New Frontier. So they have been developed since 2019, and we have a track record that we can display to you since 2020. The purpose of these US-only strategies has to be to meet increased investor demand. US-only strategies have become far more interesting to many people than for many different reasons, and we will go into that. But they also are a way to complement our global, our tax-sensitive, and income offerings. In some sense, they were a missing piece of what it is we have been doing. So let me talk a bit about what they are, okay? So they are just basically our core strategies to US. So we still have 6 systematic risk levels, 20 to 100% equity. We have the same New Frontier multi-patent technology, optimization, asset management, and process. But we've now focused on the US, and when we do, we have an expansion of the kinds of ETFs that we try to capture the growth and value in US. We are focusing more on the evolving equity and bond market. That is something that many investors are paying a lot of attention to. In some sense, it's so simple. It's the same bottle, but different wine. For all of you, it is meant to be more opportunity for advisors to fine-tune their investment decisions, to have things to do both globally and in domestically as well. And we're trying to find more tools that are useful to deal with recent global and domestic volatility. So, basic issues. By the way, this is a short presentation, so if you blink a couple times, it'll be over. Okay. So the basic issues are: there are investors that have dollar-denominated liabilities, and for them, US-only strategies are the right thing to do. If you're planning on sailing your boat in the Mediterranean or in the Caribbean, maybe you want global. But if the boat is okay in Lake Winnipesaukee or Lake Tahoe or Lake Minnetonka, that's dollar-denominated liabilities. US-only strategies are important to you. It's also an important opportunity to hedge pure global investing. So you may or may not have a view about global investing that perhaps was more positive at one time period than another. By having the US-only strategies available to you, you can hedge that risk. Nobody knows whether US is going to continue growing as it has been recently, as we all know. But on the other hand, it could be a good idea to hedge 50-50, global and US. It has been a missing component for our core investment strategies. It seems so natural to think about. We should have had a US-only strategy for some time, but we have it now. The most important thing, and Robert was pointing out to it, is that global is often US. More than 60% of global is just pure US. So US is definitely important, and it's almost as important as anything. And domestic investments have more interest for many kinds of investors. Some investors that just simply can't be anything else but US investors. And so the US core could be a very nice core strategy for you as well. To some extent, you might think that we have been a little bit prescient here because we thought of the US economy as really curing in this way. And now we have had fairly recently, but an important, powerful bull market in US equities. the economy is curing, and it seems, hopefully for a good long time, but for the moment at least, there's a declining inflation. I'll know that. What is it, 3.2% growth in the economy the last quarter? That's news. It's a very strong economy. We see the end of the Fed interest hikes, and some people think we've already landed softly, so we may have avoided the recession that others had been forecasting. So there has been disappointment in a number of non-US capital markets as well. Now, the interesting question is really, what else do you want to invest in besides the US? And that's a tough question. That's a tough question. So anyway, let me just quickly summarize what it is I wanted to say here. Yes, the US core strategies extend investor options. That's, I think, a good thing for anybody, for all of us. We are trying to meet current demand for US only. To some extent, we've been a little bit prescient and expecting that to happen, and it has been happening. It is a strategy appropriate for many long-term investors, whether they're sailing their boat in the Mediterranean or in Lake Tahoe, okay? And this is a completion for us in New Frontier of having a full suite of standard core offerings, something that we've been missing for some time. Thank you very much, and let me turn it back to, I believe, Robert.
All right, thank you. So I will, as it turns out, we have had some asset allocation changes and rebalances, and in particular, we have changed our and rebalanced our US core portfolios. Many of these changes, actually, you sort of saw the preview in terms of what has been going on in terms of fixed income markets and also in equity markets. And so they will pretty much mirror what has happened there. So there will be certainly changes and shifts towards to take advantage of the yield curve. One thing to point out in the US core portfolios is that they were changed to a new, more representative, more broadly representative across mid-cap as well as small cap ETF that also has a lower expense ratio. So that's an improvement in addition to the rebalance. As Joy mentioned, there were no capital gains for, I'm not sure quite how many years in a row, but it's been a few in any of our ETF strategies. And in the also in the tax-sensitive portfolio, we rebalanced our tax-sensitive portfolio early this year. That's not a complete coincidence from a risk perspective. We could have either done this trade late last year or early this year, but we want to be sensitive and acknowledge how your investors use these and how they don't like end of the year surprises. And if it's not statistically required for serious risk management, then we are going to defer to taxes when we manage our portfolios. And so some interesting things that happened here, in addition to switch to some of the taxable bonds because they're more efficient for even taxable investors, is that also the portfolios did manage to navigate some of the changes in equities while selling relatively very small amount of some of the asset classes like large cap growth that had really spectacular performance. And so we are able to, since we have a number of ETFs in these portfolios, adjust the whole portfolio to make the trades as well happen in a tax efficient way. So even though we're a model portfolio manager for most of you, we are able to thoughtfully manage the model almost to give you the experience of having somebody who's thoughtfully managing the account and looking into your account. Because we certainly do look into the accounts and see what a typical investor has when we manage a tax-sensitive portfolio. It's something we're very proud of, and it's a place where optimization can work quite well. All right, well, before we get into broader issues, we are going to have our second poll. So our second poll is going to be a little different than first. And what are your top concerns for investing this year? Are you worried about interest rate volatility, missing out by staying in cash, which many investors have done, the risk of a recession, geopolitical risks, or elections. So I'll give you a few more seconds. We don't want to rush, but we do want to be on time. So let's see how this works. So geopolitical risk is the top concern. And I imagine many people are lumping regular political risk and election risk in there as well. But with a couple wars going on, that's something that we're concerned about. We will. I will get to talk about a number of these things going forward. So what's driving markets now? This is always tough because I would like to talk about so many things here, but I have to focus on a few. And so one thing that I think really matters for investing, and I do try to bias what's going on in the world for things that matter for investing, things that you can analyze and quantify, is what's going on with bond volatility. So certainly after 2022, want to be extremely concerned with bond volatility. And so one thing that we do regularly is that we pay attention to the change in daily basis points of the treasury rates across the different parts of the yield curve. And so that's what you see here. You see the height of these two bars are the number, I guess they're percentage points. So if you see a number like 0.05, then that might mean that about 5 basis points on average is the typical standard amount of volatility that you might expect from for a bond of that duration. So treasury bond of that duration. So what you see is across the board that last year there was significantly more interest rate volatility across the yield curve. Much higher at the short term, so that should be no surprise because you have a Fed that is actively managing the short term of the yield curve and a market that's trying to guess and figure that out rapidly. And there were some changes along the way there. But you also see that there's still significantly higher volatility than even for longer durations. And that's always a bit of a sort of interesting thought here, which is why when the Fed is just changing the short-term interest rate, why would that change a 30-year interest rate? And I think the answer is that although sure, it has very little to do with how much a 30-year bondholder is going to receive over the next 30 years, what the Fed does today, but what is going to happen over the next 30 years is highly uncertain. So any little bit of change in terms of expectations or new information might have a dramatic impact on what people's long-term expectations are. And so that's why you see things that should be like very long, very stable. You can also think about the value of a company. Companies should be long-lived, 100-year entities. What does this quarter's profit have to do with the value of some giant corporation over the next 100 years? Well, it might actually have a fair amount to do because your confidence in what's going to happen over the next 100 years is pretty low. So you can small flaps of a butterfly's wings might have a big effect going later in terms of expectations. So the volatility is higher. It's not just over the last year, this is right now. Fixed income volatility remains somewhat elevated. That's sort of gives extra weight to maybe we don't want to be taking so much interest rate risk right now when you're getting more return from the short end of the curve. And you might even have decreasing returns for increasing amount of risk as you go out on the curve. And so why not take risk somewhere else where you have more confidence that it is going to improve long-term return? So bond volatility is high. I want to add that people have brought up, while we're still talking about bond volatility, concern about the debt, right? When I'm thinking about risk going forward, I think that something like a high debt means that their bonds are even more levered. There's more uncertainty about future rates, and that only adds to volatility. So when I look at this and think, is fixed income volatility high now? And is it going to persist in the future? that gives us some reason to think that it might actually persist into the future, and that these blue bars on the bottom are going to sort of gradually work their way up, and the long term will look like where we are right now. So one thing is always the future of rates and how much disagreement is there. And we know that markets are being very cautious in terms of thinking that the Fed may have to pivot strongly. And there are many rate hikes predicted by fixed income markets. But this is not as much strong as what the Fed is thinking, which to me is another good reason not to take fixed income volatility and get too far out on the curve. Now, inflation, I know I said I want to stick to things that that are really affecting your portfolio, but it is a kind of puzzling. Why do people hate inflation so much? And I think this has something to do with sort of asymmetric risk preferences. Like it's similar to if you lose some money one day and then you find the money back the next day, it hurts more when you lost it than when you find it back. And so you're not back to where you started emotionally, even though you are financially. I think inflation has a little bit to do with that. Right? If your salary is going up, if all of your investments and your house value is going up, but also all of the prices and costs are going up, all at exactly the same rate. You just don't feel as good as if things had been more steady, right? You feel the pain of having to pay more for something you definitely don't think you should have to pay that much for, more than you feel the joy of seeing different parts of your world appreciate in value. And so I tried to think about, is there a way that you could maybe anchor in the past to understand this pain? This is a semi-successful experiment, I think. But what it does clearly show is if you have sort of a long-term view of inflation, because a one-year horizon is arbitrary. It has a full cycle of a year and their seasonal effects, but other than that, it's just a year is just a year. Why are you measuring inflation over a year instead of over 2 years or 10 years? And I think that people do think further back, and that has a lot to do with why they're unhappy. So the other great period of unhappiness, of course, was in the late 70s when people were very unhappy about inflation. But it's been kind of not a big problem from then until now, and that makes people unhappy. So thinking about the major economic scenarios, recession, and these affect broad and stock and bond markets to a great effect, and also the risk of your portfolio and where you should be thinking and how much you should be allowing your clients to get a little euphoric and take more risk or not. Now, equity markets are very firmly in the soft landing camp, and that makes me nervous, right? When I'm most nervous, and many good investors feel this way, is when people are most optimistic and least nervous. And so, because if something unknown happens, or even things don't go quite as well as people might expect, then the equity markets aren't discounting for that. And that means that there could be some pain for equities in your portfolio. Now, bond markets seem like they are expecting a lot of rate decreases, which means they are expecting the economy to slow down, or something to happen to make the Fed want to lower interest rates dramatically. And so that, for many people, the explanation is that they may be hedging a risk of a recession. And so that's somewhat contradictory, and that adds a bit of an added challenge for your portfolio. So this is my personal concept of Pareto transitory. So I think that markets have largely acknowledged, that most people have, and economists have largely acknowledged, that inflation was largely transitory. There's this whole debate about, is inflation coming back down on its own or not? And I think to a large extent, as the pandemic worked its way out, as supply chains went over, inflation would have naturally come down to some extent. And to me, I call it the Pareto, because this is the 80-20 rule. where the first 80% happens with easily and broadly, and the last little bit is the hard part. And to me, this is a risk that if the Fed is really determined to get inflation down from 3%-ish to 2%-ish, then they might have to make some hard choices. And in a political year, who knows what that means? And so that just adds to the uncertainty of the portfolio. And then recession is not completely off the table, and so there are unknowns out there that could affect it. So kind of the final thing that I want to make sure to mention is that last year Harry Markowitz passed, and so this makes us really want to emphasize some of the gifts that he has given us in terms of how to think about investing. And I've been trying to explain it simply that optimality really has two main components. It has the ability to efficiently maximize return, minimize risk through clever asset selection and thinking about the relationships between assets. But it also has the ability to really customize a portfolio for an investment goal. And I think that's very important across all of our different strategies, not just in the obvious way of the tax optimized portfolio versus not, but also thinking about how an aggressive portfolio really has a very different mix of stocks and bonds, not just more stocks than a conservative portfolio, because it's a different investment goal. And so it should be either going after return opportunities or being more defensive in different ways. And of course, the most important thing is always think about the portfolio. And this is difficult, and this is pervasive. And we always want to just look at one ETF in our portfolio or one stock in the ETFs and really have a strong opinion about that. But what is really important is how all of our assets fit together and whether they are supportive and optimizing our chances of meeting our investment goals or not. So we are just a little bit behind time. I was really excited to talk about Bitcoin. I will say this very briefly, that we had a lot of questions about how to think about it going forward. The most clear parallel is thinking about the gold ETF, which is a very similar situation. Before, it was hard to invest in gold. There was no real way to put it in most investors' portfolio. Then an ETF comes out and it becomes an investable asset. Now, we're definitely not speculators. We're always thinking about it from a risk perspective, but it coincided with when gold became an investable asset, the price of gold appreciated for quite a long period. And I think those were not pure coincidences. With Bitcoin, that raises the obvious question: is Bitcoin being an investable asset going to make it more valuable in some sense? And the answer has to be at least a little bit yes. Unless what it does is it pulls off the covers and shows how Bitcoin has massive flaws, then making it an investable asset has to be more valuable than if it wasn't. So that said, I have no view on the direction of Bitcoin, and I think it's very interesting and a sort of confirmation that markets really are doing what they're supposed to do. That where you saw all the price movement in Bitcoin is when they got information started to leak out that there would be these Bitcoin ETFs. That is when, and a lot of that started to happen last fall, when the price of Bitcoin really started to appreciate. And you would even have basic supply and demand things like BlackRock is going to hedge the possibility that they're going to have a new ETF out, so they're going to start buying up some Bitcoin in the background. So some of these things are kind of hard to hide. But then, of course, interestingly, as soon as the Bitcoin ETF is released, the price starts going down, which makes a lot of sense when you're thinking deeply about markets, but not a lot of sense if you're thinking like, shouldn't that be the point when price increases? And so you always have to understand, what do markets know and what don't they know, and what do they expect about the future? So I think I should stop talking about this here, and I maybe open it up to some of the questions that you are on our clients' and advisors' minds. As you are hopefully typing in the questions, and And as Joy will be joining me in a moment, I just want to give you a few takeaways. So bond risk is probably here to stay, either through a combination of higher debt and continued uncertainty about the future Fed rates. And so it's something to keep in mind and be concerned about in your portfolio. That said, just like Bitcoin is efficiently priced by the market and a lot of information, investors know that stocks are risky, that investors know that there are a lot of risks out there. And so they will, of course, have discounted the price of them so that in the future, there should be a positive expectation. In theory, this should even happen in markets like China, although China has government intervention, which makes it a little more complicated. And then finally, with the concentration, with the many risks out there, I think it's a very important case for diversification across your portfolios. So now, hopefully we can get some interesting questions.
All right, so thank you everybody for your participation throughout the webinar. We've been gathering a lot of great questions, so let's get started. And please keep in mind, if we don't get a chance to answer your questions, we'll reach out to you directly afterwards. So our first question is about the timing of the first Fed rate cut. Joy, can you explain the effects of possible interest rate cuts and how different levels of Fed rate cuts may affect the market?
Yeah, sure. Thank you, Catherine. So currently, markets are pricing in about 45% chance of the first rate cut by March, and in total, 5 to 6 rate cuts by the end of this year, definitely more aggressive than what the Fed has indicated. And this divergence, as Robert mentioned, that will continue to add risk to markets. And I would say the impacts really lie to there's reality versus market expectations. Generally speaking, right, if rate cuts meet expectation at the end of the day, it's typically like a good sign, reducing uncertainty. But if rate cuts are due to a worsening economy or are less than expected, then the market response tend to be muted or even negative.
Yeah, that's great. I mean, the other thing that's very important to consider is like currently the yield curve is inverted. That might have implications, not just for bonds that are really obvious, but it also has some implications for how risky equities may be affecting each other. If there is no return for risk for taking interest rate risk right now, how does that affect other parts of the market?
Great, thank you. Our next question is about the election. Robert, do you mind diving into what effect you anticipate the coming election may have on equity and debt markets?
Okay, so this is politics is always a good thing to not get too deep into. One important observation is that politics tends to be very emotional and markets tend to be very rational. And so we have seen results of a couple of elections in the last 2 cycles where there were some very strong emotional reactions, a little bit of market volatility right at the start, but then markets figured it out and markets generally did quite well through a variety of administrations and different political beliefs in spite of what some people's emotions might have told them one way or the other. And so I think that while there could be dramatic social implications, also the different parties' policies on debt doesn't appear to be that different. The cynical attitude is that everyone cares about what the other party is spending, but not what they're spending, and so that is also not likely to be dramatically affected by the election. So it's something that we certainly pay attention to and are going to watch. We're going to look for volatility, but it's not something you want to speculate on or take one side of.
All right. Let's see. Robert, can you talk about if you think that we'll have a recession in 2024?
Yeah, so I told you my concern is that we still could make ourselves have a recession. It seems like everything is pointing to the economy being extremely resilient, including today's surprisingly pretty good GDP number, continued strong labor market, fairly low inflation, but not as low as the Fed would like it. So it really does come down to to some extent. Why is there something unexpected that happens in the future? Do we make some missteps? Do we start paying for having too much debt? Or political dysfunction? I mean, a lot of things can go wrong that could lead to a recession. But I think the path that we're on is that there would not be a recession unless we want there to be one. And so it's not clear whether the Fed is willing to do that.
All right, great. And we have time for one more question. Can money be made in appreciation with buying longer term bonds now versus after interest rates drops? And maybe also lock in higher yields?
Yeah, so this is something that definitely is for bond analytical people on top of mind. So the way that generally Treasury markets are meant to work is that the markets are anticipating potential future interest rates and want to make sure that there are no arbitrage opportunities there. So that means that at least over the very short term, like over the next year, then the expectation is that if you hold the shortest duration, you hold Treasury bills and Treasury notes and just roll them over all the time, you should end up on average at the same place as somebody who had, say, maybe a 1-year Treasury and just held that for the whole year. And so there should be no difference in terms of the expected yield that you get. So the concept of locking in high rates now is largely a myth. You can lock in the rates, but you're not expected them to really be higher than if you don't. And you just keep rolling along and investing in short duration securities. The place where you will win or lose is if you have either different expectations in the markets and you turn out to be right or wrong, or if the market prices are not just saying, here's our risk neutral way of thinking about the world and trying to do our best guess of what future rates are going to be, but they're also saying, we're really worried about maybe a recession. And so we're willing to actually buy insurance and take a negative expected return. So we're actually willing to accept lower rates in the long term because it has that insurance and risk hedging characteristic that you have a hard time finding anywhere else. And so what that oddly means is that if that is what is sort of driving market prices, then you would actually expect to do better by sticking with short-term things rather than locking in longer rates. Now, if you have a long-term investment horizon, locking in a long-term rate of return is very sensible, right? That's what insurance companies do. That's what pensions do when they know they have long-term liabilities. If you have a 30-year horizon, then the risk-free rate is the 30-year rate, not the current 5.5%.
All right. Thank you, Robert. And thank you everybody for attending and submitting so many great questions. As always, it was great to hear insights from Robert and Joy. To finish off today's program, please remember to take the brief survey before you go. And we'd also like to announce that our Q1 Market Perspectives webinar will take place on Tuesday, April 23rd at 1 p.m. And you can register to that using the link that was just sent in the chat. If you have any questions, please don't hesitate to reach out to a member on our team. And thank you again for joining, and please enjoy the rest of your day.
Thank you.